So, a company makes a sale. Simple, right? Customer pays, money comes in, boom, new revenue. But what if I told you it's actually way more complicated than that? Today, we're going to decode one of the biggest questions in business. When has a company really earned its money? All right, let's just jump right in with a little scenario. The answer, you'll see, opens up this whole framework that basically every company on the planet has to follow to report how well they're doing. Okay, here's the puzzle for you. Imagine your company sells a bundle deal, a new computer plus a 1-year tech support plan, all for one price, $420. The customer pays you the full amount today, and you hand over the computer today. So the big question is, how much of that cash can you count as revenue today? Now, if your gut reaction was the whole $420, hey, that's the logical answer. But in the world of accounting, that's actually wrong. You see, just because the cash is in your bank account doesn't mean you've earned it all just yet. There are some very specific rules you've got to follow. So how do we figure out the right answer? Well, we turn to the official rulebook. And believe me, this isn't just some company policy. It's a universal standard that lays out a clear 5-step process for pretty much any business. And here it is, IFRS 15. You can think of this as the global gold standard for how to count your money. It was created specifically so that $1 of revenue means the exact same thing whether you're looking at a company in Tokyo, Berlin, or right here in New York. And this whole massive standard is built on one single powerful idea: revenue recognition. The key words here are truly earned. It's not about when you get the cash, it's about when you actually deliver on the promises you made to your customer. And this is how it's done. The standard gives us this exact 5-step model to use for any sale. It's like a roadmap that takes us from a messy, real-world sale to a clean, accurate, and honest number on the books. All right, let's grab that roadmap and head back to our computer sale. We're going to walk through these 5 steps one by one and solve our little $420 puzzle. Step 1, this is the foundation. Is there a contract? Yep, it doesn't have to be some fancy legal document. It could just be a receipt or an online checkout. But there is a clear agreement. The customer promised to pay, we promised to deliver. Check, easy. Okay, step 2 is where things get interesting. We have to unbundle the sale and pinpoint every separate promise we made. Accountants have a fancy term for this. They call them performance obligations. So in our case, we're not just selling a computer bundle, no. We're making 2 distinct promises. 1, to deliver a physical computer, and 2, to provide a tech support service for a full year. Step 3 is the easy one. What's the total price for everything included in the deal? That's right on the receipt, $420. Done. Now this is where it gets really clever. For step 4, we have to take that total price, the $420, and divvy it up between the separate promises we identified back in step 2. We have to figure out how much of that money is for the computer and how much is for the support. And the way we do that is by looking at what each of those things would sell for on its own. So in our example, the computer by itself sells for $300, and a year of support sells for $120. So that's how we split the money. $300 gets assigned to the computer, and the remaining $120 gets assigned to the support plan. And finally, we've arrived at the final step, the one that brings it all home. We can only officially recognize, or, book, the revenue for each part of this deal after we've actually fulfilled that specific promise. And here it is, the answer to our puzzle. For the computer, we delivered it on day 1, promise fulfilled. So we can recognize that $300 in revenue immediately. But what about the tech support? That's a promise that lasts for 12 months. We earn that revenue bit by bit, over time. That means we can only recognize $10 of that revenue each month for the next year. So, puzzle solved. But this 5-step logic, it's not just for computer bundles. It helps clarify all sorts of complex business setups. Let's look at another one. Okay, this quote from the rulebook points to a really critical question companies have to ask themselves. Basically, are we selling our own stuff, or are we just helping sell someone else's stuff? In other words, are we the main actor, the principal, or are we just an agent? And here's why that difference is so huge. A principal, like a department store selling its own brand, gets to record the entire sales price as revenue. But an agent, think of a travel website selling a flight for an airline, they're just the middleman. They don't get to claim the full price of the ticket as their revenue. Nope, they only record their piece of the pie, their commission. So if an agent helps make a $45,000 sale and gets a 10% cut, their revenue is only $4,500, not the whole 45 grand. It's a massive difference. I know, at this point you might be thinking, wow, this is a lot of work just to figure out one number. But trust me, getting revenue right is one of the most fundamental, most important things any business does. It's all about painting a true and fair picture. For investors, it means they can actually compare Apple to Google, literally. For business owners, it means they're planning for the future based on what they've actually earned, not just what's in the bank. And really, for all of us, it creates a market where everyone is playing by the same rules, which builds a whole lot of trust. So, I'll leave you with this final thought. We've just gone through the right way to do all of this. These rules are all designed for honesty and clarity. So now that you know how it's supposed to work, what do you think a company might be trying to hide or maybe inflate by bending those rules?